welcome everyone. My name's Joel Clark, and as Jeremy mentioned, I'm CEO of KJ Harrison, which is a firm I've helped build since inception over the past 15 years with a group of partners. And if you think about the markets over the last 15 years, we've gone through two fairly big crashes, starting with the tech crash where the market dropped 50%, and then 08-09 where the market was down close to 60%. And during that time, I've seen a lot. I've seen a lot of wealth destruction. Families who have spent multi-generations building up their wealth and have lost it. And not only did they lose it once, but all the lessons from the tech crash very quickly 5 years later were duplicated again. And what's striking today is the fact the market is at an all-time high. And so you go through two 50% crashes, two wealth destruction events, but yet the market is at an all-time high. And so the perspective I want to bring today is on how to sort of protect your family's financial future by being totally aware of the behavioral biases that can undermine your family's wealth from building it and maintaining it. So I'm going to introduce you to what is called the investor behavior penalty. I'm going to talk about 3 of those behavioral biases that can undermine your wealth, 2 solutions to overcome those biases. And then I want to leave you with what I think is going to be the next really big capital allocation mistake that can truly undermine your wealth going forward. So here is a very big point, which is the fact that investors have sacrificed almost half their potential return by engaging in self-destructive behavior. And this is a study that Dalbar has done, in this case from 1996 to 2015, where it's amalgamated all the results from investment managers in the market. And during that period of time, the market's done, or these funds have done 7.7% per year, but yet the average investor's only done 4.7, or just over half of that experience. And why is that? And that's basically because of human emotions. As individuals, we're completely flawed when it comes to investing. We're very good at designing unmanned cars, putting people on the moon, solving cures for all these issues in the world, but we're absolutely flawed when it comes to investing. And this type of behavior can really jeopardize your wealth. And I just want to introduce you to 3 of those behaviors. There's a whole bunch of them, but these would be the 3 most important sort of hardwired behavioral traits of significance that can undermine your wealth. The first one being short-term bias, second one being the herd bias, and lastly, the vividness bias. So short-term, human beings are hardwired to focus on the short term. We find the chance of short-term gains very attractive. You think about all those times in Vegas when you're up, the excitement's flowing, you're making a few $100s or $1,000, it's going. It really stimulates that emotional part of the brain where we release dopamine, and it makes us good, makes us feel positive. But we start to exhibit very impatient behavior when it comes to when we focus on the short term. And I'll give you an example. There was a study done where someone was offered $10 today versus $11 a week from now. And everyone chose, or the majority of people chose, $10 today. But when offered $10 a year from now and $11 a year and a day from now, everyone, or the majority of the people, chose $11. So when we make short-term decisions versus long-term, it's different parts of the brain that drive that behavior. We have immediate gain versus delayed gratification uses different parts of the brain, and successful investing is really about, a long-term discipline. It's relying upon that side of the brain. The average holding period for stocks in the 50s and 60s was 5 to 6 years, and today it's down to 11 months. And as private business owners, we know that the intrinsic value of a business isn't determined by 6 months and a year. So why are people making decisions in such a short-term fashion? So here's, you always rely on the really smart investors in our industry to give perspective. Probably the brightest and most successful is Warren Buffett, but he calls the stock market as a device to transfer money from the impatient to the patient. And what I love about this chart is almost the same analogy of the last 15 years. This was done 1981 to 2015. But look at the long-term wealth created on the right chart over that period of time. Very easy to do, right? But on the left side, look at the invariable swings, plus and minus, on any given year that throws people into a tailspin. And then also think about the news that goes along with that. Think about the news and the headlines that went along with the tech crash and that recession or the financial crisis. Even though we all know we're supposed to buy low and sell high, it's very hard to do, and the behavior suggests otherwise. Human beings are hardwired to herd. We're all very social in nature. We all want to be accepted. None of us want to be an outcast. And that social inclusion, that part of the brain is the same part of the brain where we feel physical pain. Many of us are parents. We hate when our kids come home and, their friends have done something tough on them and they're sort of alone in that schoolyard. And that social exclusion is an awful feeling, but successful investing or contrarian investing is the equivalent of seeking out social pain. So there was a great experiment done in the 50s called the Solomon-Asch experiment, and it was a study of conformity. And there was a whole bunch of studies done, but the most probative one as it relates to investing was where they had a table of 10 individuals, 9 were planted to say the wrong answer. And you had a matchstick X compared to 3 others, A, B, and C, and it's all very obvious to everyone in this room that X matches B in height. So you went around the table and all 9 purposely said the wrong answer. 37% of the time, when it got to the last one, they sat there, geez, what do these guys know that I don't? I mean, I think I know what it is, but maybe they know something more than I do. 37% of the time, they changed their answer that they knew was absolutely right just to conform with the crowd. Okay? That's investing. Investing is very behaviorally driven, especially in the markets. So let's draw upon those 2 experiences that I talked about in the last 15 years. This is my favorite graph when it comes to articulating success in the markets. So here we are in the top left. What we have here is the yellow line is the S&P, goes down to the 02 low, goes up, etc. And the blue bar are fund flows into the market, which is above the line, and out of the market below the line. Money comes roaring in at the pinprick high in the tech bubble. You have a 50% crash, money comes flying out at the pinprick low. You start to build confidence, things recover, money comes flying in at the pinprick high in 07, right before the financial crisis, comes roaring out at the low, and is now starting to eke its way into the market now after 8 years of recovery. We all know we're supposed to buy low and sell high. The opposite completely happens, which is why investors only get, on average, half of the return available in the markets. It's an incredible picture from my perspective. The third behavioral trait is what's called the vividness bias, okay? Human beings are hardwired to project the immediate past into the distant future. We draw upon, here's another great quote from Warren Buffett. People tend to underestimate low probability events when they haven't occurred and overestimate them when they have. And you think about that, we're all living with the ghosts of 08, 09 or driving our decisions today, but we're not thinking about those decisions in the future that are very low probability but very high severity type events. And here's another quote from Warren Buffett. Investors drive while looking in the rear view mirror versus out the front windshield. And let's draw upon another example which everyone here will recognize, which is Microsoft. So let's go back to its early foundings when in the early 90s, when the stock price was $1.20, EPS was 6 cents, and the value of their business was 20 times earnings. So over that decade, the stock price went from $1.20 to $53. So 46% compounded annual return in that stock, and the EPS compounded at 30% a year, and money roared into that business at 62 times earnings at a price of 53. Why? Because they looked back and said, well, they just compounded their stock or the growth of their company at 46% a year. I'm now going to project that out over the next 10 years. Just happened the last 10 years. I'll buy it today thinking that's going to happen in the following 10 years. Well, we all know that from 1999 to 2011, that's not what happened. In fact, the stock went from 53 down to 25. But look at EPS. EPS still grew from 85 cents to $2.75, which is a growth rate of 10% a year. We're all business owners. We'd love to grow our business 10% a year. And bottomed out at 9 times earnings, and no one wanted Microsoft. They're dead. Bombers screwed up the company. They've lost their way. It's a disaster. 9 times earnings. If you looked at the volume chart, all the money came out of Microsoft. And here we are today. Microsoft is at $57, stocks up 15% a year. Earnings, in fact, are flat, which is sort of interesting, and you're back to paying a higher multiple. This is a recurring pattern in investing. You're always focused on what a company's done in the past instead of really projecting out in the future. Okay, so now I want to talk about 2 strategies to really overcome this behavior, and why they're important. I want to draw upon, example of a client we had that 2 cousins, they sold their steel business in the U.S. In early 2007, and one brother took the time to define financial success, educate themselves, went through a goal-based planning process, spent a lot of time interviewing managers, understanding asset classes. The other cousin took the money, started whipping it around. He was a big shot, really didn't spend time thinking about it. And of course, he ran into that freight train called 08, 09 and completely lost all the money. So you had 2 examples of one cousin who preserved it, the other one, human behavior. And of course, when he's faced with the market being down 60%, illiquid investments, couldn't get them out. He completely panicked and has basically jeopardized all the capital that 3 generations took to build it. So what do I mean by defining financial success? That's really sort of a process that you go through to understand your goals and objectives and to really focus on what I think are 2 important points. One is risk tolerance, and the other one is time or horizon and your liabilities. And what I mean about risk tolerance is, you meet people and sometimes they have enough wealth that they don't need to take risk, or they have enough wealth they can afford to take risk. You got to understand who you are. Are you really innately a risk taker or not? Met people who don't have enough wealth. They don't have a pension, and they're forced to take risk when they really shouldn't. They need 10% return on their portfolio just to meet their lifestyles. And when you think about the risk tolerance to achieve 10, they really shouldn't be doing it. So that process to probe your risk tolerance is really important when defining financial success. The second is what I call time horizon and liabilities. When you think about the matching principles of liabilities and assets, and you think about it in the context of your life, your lifestyle needs are short-term, month in, month out. Those are very different from inflation and legacy needs. And don't mix the two up. So when it comes down to allocating your capital, you want to sensibly match your asset allocation decisions with your liabilities. And so when you can match them to your plan, you're much more rooted in not worrying about the sort of cycles that you go through, because they're natural. In our lifetime, we're going to have 7 to 8 more economic and market cycles. It's just a natural part of business. And that's your first line of defense, is this defining financial success and allocating capital based on that. And I'd say sale of a business, divorce, any sort of liquidity events, these are very big inflection points where you should sort of redefine success. When you come into a lot of money for whatever reason, based on a change, you should bear down on that plan and reflect on it. So that's your first line of defense. The second is, back to all that wisdom from Warren Buffett and the great investors, you need a non-emotional, rational, disciplined investment process. Self-discipline, believe it or not, is a wasting asset. It's not something that it holds constant in a day. It's all we're better to work out in the morning versus the end of the day. You have all these high hopes, so you're going to pound the treadmill at 5 o'clock. You've had a tough day. You've used up your self-discipline. So self-discipline isn't enough. You really need a non-emotional discipline. And so how do you apply that? Well, whether you're managing your wealth, whether you have an advisor doing it, whether you have outside managers, they need to articulate what their process is. They need to articulate what their buy discipline is, their sell discipline is, their portfolio management decisions. It's really important for them to be able to articulate it and then prove it. Well, how do you prove it? Well, go back to 2002 and go back to the bottom of 2008, 2009 and see how much money they lost to prove out their discipline. This is very important. So I think these are two strategies that are really important to preserve and protect your wealth going forward. So the last thing I want to leave you is what I think is going to be the next big wealth destruction event. And you have to sort of go in today's moment where you have interest rates at 1%. But most people, just to meet their lifestyle needs, need 4 to 5%. So you have this gap between what you can get by way of safe income and what your needs are. And this is a $1 trillion problem around the world. And the longer this goes on, the more that you're having misallocation of capital to solve this problem. I mean, it's like I need to put food on the table. I need 4% a year. I can't get that. So you're seeing more and more riskier behavior the longer the interest rates stay low. And of course, central banks around the world want interest rates to stay low. They have ballooning $1 trillion debt obligations that if they're ever repriced, there isn't any amount of tax revenue that's going to carry them. So central banks around the world want interest rates to stay low forever, but your needs are a lot higher than that, and it's causing poorer and poorer behavior. So let's take the opposite of equities and look at bonds. And when I'm talking about bonds, I'm really talking about anything sort of fixed income, anything that's like bond-like, annuities, preferred shares, real estate, loans, okay? All these things are effectively proxies to solve that same I need income. And when you think about where interest rates were, they peaked in 1981 at 18%. 36 years later, they bottomed this year at virtually zero. right? You have a 10-year Japanese bond earning zero. Germany, it's negative. I mean, you can't get any lower than where they are today. So we're now at the 36th year point where this asset class, it's run its course. And of course, if you looked at the allocation based on, back to that vividness bias, well, bonds have worked for 37 years on a 2, a 5, a 10, a 15-year basis. This is a great investment. Well, it's going to be possibly the worst investment going forward. Most families have a huge allocation to fixed income, income-like equities, even blue chips, real estate. I mean, who's left not to own real estate in this country? We've had a very long run in real estate because it's worked. And that's what everyone's relying on. It's already worked. Talk me out of the fact that in looking back, it hasn't worked. And I think this is where you have to be very careful. So anyhow, that's the presentation. Really comes down to understanding those behavioral biases that make us as humans flawed, have a very definable blueprint for your wealth. Most business owners have a business plan for the business. None of them have it for their personal wealth. And be very aware of having a non-emotional investment process that you can rely on. Thank you.